Welcome back to week 9 of the Online Investor's Guide to Thriving. The biggest question we continue to get from audiences is a two-parter. Firstly, viewers are bewildered by the disconnect between the markets and the economy. They wonder when or if the other shoe will drop. Will markets retest the March lows or beyond? Secondly, they wonder if they should sit out whatever comes next in cash or possibly try to short the market. Both strategies come with great risk in themselves. These are issues we can offer some education and insights about in these free online formats, but of course, we're not able to provide investment advice. The risk you take and the return you need, or rather the return you can afford given the risk that you're able to take, is something very personal. With markets being fluid, we would really need to be able to help you navigate markets in real time on an ongoing basis in order to truly add that kind of value. Plus, we don't have a crystal ball. However, there are things that you can do with money that are difficult to do by yourself, and that's where the team Larry and I built at ETF Capital Management comes in. We're in unprecedented times, and the truth is no one really knows what will happen next. You just have to be ready with strategies for a whole spectrum of possible outcomes. Our approach is to build custom portfolios that shape these outcomes for clients. We dampen equity volatility to keep clients in their sleep at night comfort zone while deriving a yield from our option strategies because you just can't get 5% from fixed income anymore. Like you, we're looking for more clarity too. And when we see opportunity, well, we back up the truck, as Larry likes to say. If you'd like us to do this for you, there's two ways we can help. We've partnered with BMO to offer ETFs and funds of ETFs managed by Larry and available to you through your online brokerage or investment advisor. If you don't have an investment advisor, but do have a portfolio of $1 million and up, our ETF Capital Management Private Client Wealth Team would be pleased to offer you a wealth management proposal. As you'd imagine, this way of working together allows us to make the fullest use of our wealth management and investment toolkits. You can request a proposal online at etfcm.com. For those who simply want to catch the webinar replay or download Larry's slides, tomorrow morning you'll get a short email survey from us. Let us know how we did, complete the survey, and you'll get access to all of the above and the ability to submit questions for next time. Investor's Guide to Thriving, as always, comes to you at no cost in favor of supporting two charities Larry and I believe in passionately, Sick Kids and the Baycrest Foundations. We hope you can join Larry and I in supporting childhood leukemia research at Sick Kids, and we appreciate your support for the research being done at the Baycrest Foundation into the treatment of Alzheimer's and dementia. For those of you who have made donations, thank you very much. If you'd like to make a donation, please use the links in the survey you'll receive after the event. That lets Larry and I know which donations to match. Thanks very much to our sponsors, National Bank Direct Brokerage and BMO ETFs. BMO ETFs was the first and to date the largest supporter of education here at Investor's Guide to Thriving. They've been a great partner in that education, and we're always impressed by the high quality of resources they make available to investors. Speaking of a great resource for investors, it's always my pleasure to introduce Kevin Prinz from BMO ETFs.
Thanks very much, Jared. Appreciate the opportunity to continue to do some more education here. So let's get right into it, and we'll spend just about 10 minutes here, and I really want to spend some time in giving some background around gold and gold-specific ETFs. We've certainly seen them in the media on a regular basis, and we thought we'd give you a little chance to get some insights around what's out there in the gold space. And when we look at the media itself out there, we're certainly seeing that central banks, as Larry's been talking about it heavily in these sessions, that their government's printing money, right? And fiscal deficits are out there, and certainly seeing that various analysts are increasing their targets around gold because of the inflation aspects. Now, to give you some, balanced viewpoint there, of course, you got to still factor in the strong USD backdrop, as well as following equity, the volatility of the marketplace, and then of course think about the actual demand out there, and maybe there is more weak demand coming on this crisis here, where China and India are a little more weak. So there's some headwinds out there too, but more recently, you've certainly seen it has been one of the stronger performing asset classes across the board. And then just jump into the next slide here. We just want to highlight that it hasn't just been a straight line up for the gold market, of course, right? And it would be nice to say it's been a straight line up, but it's not. There's certainly been volatility in around gold across itself, right? And that's what we're showing you our first chart here. Certainly seeing during this uplift in the marketplace around gold, it's not been straight up and bouncing around. And so is other things too out there in the marketplace. And we're showing you SPY too for an example there of how it's been performing. On the other side too, though, factoring in, liquidity will still impact gold too, right? So when you think about the gold market, when the liquidity dries up, like it dried up in fixed income for a bit there, it will impact gold too. So factor those things into your overall thought process, but you're certainly seeing gold in the news. So let's talk about a little bit about different ways of investing in gold out there. And ETF companies across the board have really dove into this space and provided a whole range of different solutions out there. And different ETF companies have different philosophies how to offer this access. And so let me go through the 3 common ways of accessing gold. And I'm going to start in the middle there for everybody. And I know it's a little confusing, but bear with me. Let's start in the middle. If you want to access gold, you can start off with basically physically based ETFs. And what I mean by that is those ETFs out there in the market, and a more popular one out there, GLD or IAU in the States, what they're effectively doing is they're holding real gold bars against the ETF, and they exchange them back and forth like they would do for stocks. Now, with that kind of approach, of course, there's almost no tracking error. And what we're really saying, no tracking error, is the spot price of gold moves up and down. It's moving up in tandem with it too. And of course, there's no default risk because they're physically holding those gold bars against it across the board. Couple things to factor in with those kind of approaches. There is some storage costs that they're bearing behind the scenes. Now, gold's a very high productive, high cost investment, so the storage cost is not that expensive out there. But something to factor in across the board. And then I want to move down a little second below that. Other companies out there, of course, offer future-based solution sets out there. And what are futures-based? Okay, that's really taking derivatives and using derivatives to access the gold market. So, for example, in the States, there's a single futures-based ETF, DGL. There's some double leverage ones up there too, so you can think about those. But ultimately, there's no storage costs in there, and there's really a key factor for you to think about there. You should really know a little about contango and backwardation. If you understand those terminologies, maybe that's a solution set for you. But if you don't understand those terminologies, then maybe that's not the solution set for you. And that's kind of my guide to say go there or don't go there. It's just make sure you understand all the moving parts behind those. Then, of course, last but not least, there's also equity-based ETFs in the marketplace. And what they're effectively doing here, this is really investing in the companies themselves that are active in the gold market themselves. Now, it's not the same thing. There's not those contango and backwardation there because we're basically talking about equity-based companies. And effectively, you've got a kind of a natural leverage in there because you're basically based in companies that hold the underlying economies, and there's no storage cost. But it is different. We have 2 ETFs in this space, as well as there's XDG in the space. So there's ZJG, and ZXGD for that matter, and ZGD in the matter. Just some examples of different tickers out there, but there are choices out there. So really, if you're thinking about gold, it's not just about behaving in the marketplace, it's how you want to access it. And ultimately, there's different choices for every style investor. Take some time and decide which one is yours. Now, just to quickly flip you a little next slide to show you how they behave more recently. What we've taken here is just showing you the spot gold moving across the bottom there. GLD, big example of that, or CGL in Canada for that matter too. That's that green line cascading across the bottom. And those color code blue and red ones cascading around it, that's more of the equity-based ones. So you can see that at different times they perform differently. You're getting a little more volatility in the equity ones, and more recently, more outperformance, but definitely different styles for different investors out there. And we're still seeing money moving towards gold ETFs across the board, whether they're the equity ones or the physical ones, really trying to take a look at that inflation hedged trade out there across the board. That's a little bit about gold ETFs. Let me, before I do hand it back to you, if anyone wants to hear about more insights around the marketplace itself in general, we are hosting weekly a half-an-hour webinar at 1 o'clock. We invite you to join us. Tomorrow, we're going to have our guests, MSCI, and actually, we're going to dive into a little bit around ESG investing and how they behave in the current marketplace. And while investing in good is actually good, so if you want to join us, please consider that. Let me hand it to Larry to take it away from here.
Great, thanks very much, Kev. And again, thanks to all our sponsors for support of this new version of what a roadshow is all about. And we were casually talking, when are we going to get back on an airplane again, and when is the economy going to really open up? And we're going to see pretty significant behavioral changes. And ladies and gentlemen, we're at the very, very early stage of this, and it's really quite something to see the discussion out there about V bottoms and a lot of questions tonight. So I'm going to cover a bunch of things tonight, but I want to talk about who the new buyer of last resort is. And then I want to dig into the fear and greed index. For weeks, I've highlighted it as something we should look at. Tonight, we're going to look at all the individual components and what they mean and how to interpret them. I think that'll give people a good understanding and to help answer some questions for them. And then I'm going to take a look through the eye of the storm, which I believe we're in, and then we'll get into your Q&A here. So, this is the core of everybody's question. What should I buy? Should I buy this? I already own it. Should I buy more? Should I sell it? So it's the buy, sell, and hold question. And the answer is very simple in terms of understanding yourself, your ability to execute, your ability to do it in an unemotional way. And for the vast majority of people, we ride this roller coaster of market emotions, and everybody has it, including me. And I'm an expert in this, and I've been studying the behavioral side of investing for the better part of 20 years now, and you still get caught up in it. I still ask the same questions. Larry, what if you're wrong here? What if this isn't the eye of the storm? This is a V bottom and it keeps going up, right? And so what if that is the real outcome? And so, my approach is always a weighted average. And when the probability of the outcome is very, very good in my interpretation of all the inputs, and we'll look at a lot of them tonight, then we make a bigger bet. And when the probability of outcome is not attractive, we make a smaller bet. And for some people, that might mean speculating on the short side. And for other people, that might mean sitting in cash. There's no right or wrong, right? It's all about you and your needs and having a plan for you. Just like Andrew Cuomo says, it's about you. Wearing a mask is about you protecting other people, right? So how much risk you should take. And the dirty little secret about risk and return being linked is that you only need to take smart risk in your portfolio. And frankly, right now, what I'm going to go through, we'll see. You have to make your own determination. Larry might not be right. Larry's done an evaluation of how many times when I've written a report or made a comment, and I'm right about, call it 2/3 of the time, which means I'm wrong about 1/3, right? That's a big number, right? The Hall of Famers in baseball hit the ball 3 out of 10 times, and they're the best. In the investment world, if you're less than 50-50, okay, forget about it. So you got to be better than half when you're making a call. Otherwise, buy a low-cost ETF, get the index return for as cheap a fee as possible, and don't worry about it. Just get your mix right. And the problem with that approach, of course, is the low return that bonds offer. And fixed income, I've been saying it for years on BNN, yields are going to stay low, and that part of your portfolio is probably permanently impaired in the world we're heading into. So I want to, for the first time, I want to try this polling thing. And I'm going to launch a poll here. And the question is very, very simple. Okay, so it should come up here. Very, very simple. Will the S&P 500 next move be 10% higher or 10% lower? We've got a little over 1,000 people online here. I want to get as many people participating as possible in this. I'm going to let it run for about a minute to get an idea of the sentiment out there. I'm going to talk for 45 minutes or so, and then I'm going to ask the same survey again and see if anybody's changed their opinion or the breadth of people have changed their opinion here. So we'll see how this goes. I've got right now 48% of people have voted, so half. So that's a really big number. We'll let this keep going. It looks like getting a lot of participation here. I don't want to let it run too far, but we've got about 70% reporting. I think that's statistically significant. I'm going to close it off and I'm going to share it with everybody so we can have a look at the results. So basically 80% of people, 72% voted. So over 700 replies, 80% of people says lower or higher. So maybe that's the kind of crowd that Larry Berman attracts, because I've said for many times I might be the best bear out there, but I look at the risk side. And the vast majority of people you hear on television and CNBC, and they're always telling you a story. They're always bullish on something. And for the most part, I am too. It's just not equities at the moment. So that's interesting. There's an overwhelming bias to be cautious here, and so that leads to me to the next obvious question here, and that is, who's been the buyer? So hopefully this will work for me here. Come on, click away. Okay, so who's buying this market? So I saw this article just came out the other day in the Financial Times. And if those of you who signed up for Rosie's free trial, he mentioned it today, which led me to click on it. I read the article. So people who can't bet on sports betting anymore are now turning to the stock market. So this is interesting. So the combination of Schwab, E-Trade, Interactive Brokers, I'm sure it's not very different here in Canada. You have seen a massive increase in new accounts. And it looks like, 800,000 new accounts. Wow, in the last couple of months. And so they interviewed this guy, Daniel Goodwin, who oversees a team of paralegals at a law firm, not an investment professional. And he normally punts around $100, couple $100 a night on different games because he likes the action. He's a junkie. And he says, I'm not here for the long run. I just want to throw $1,000 at something, see if I can make a few hundred. And this is the quality of the investor today. To me, it's completely speculative, because if you look at fund flows, if you look at institutional investor surveys, if you look at cash positions in certain types of accounts, it confirms that this market is so very speculative, and these investors may not have the intestinal fortitude that's needed. So let's have a look at fear and greed. Current index now is on neutral, but it is really important that we look at the makeup of this. And I said it's a 7-factor model. I'm working on an ETF capital management version of this that people can do on their own by looking at different ETFs, and it'll be a very good sentiment gauge, and it will help people navigate. So let's look at the first measure here of put and call options. So you're looking at a 5-day average of the volume trading in puts relative to calls. There is a natural skew towards seeing more call volume than put volume. And the primary reason of that is because most people don't hedge all the time. They don't speculate on the downside, but there's an incredible amount of money that writes calls for income. And BMO is amongst the best in that world on the covered call strategy. So you can see there's a natural skew to the downside. And at the extreme, that skew gets to about 2-to-1. So we can see in January, the ratio put call 5-day average got to about 0.5. and historically very, very extreme. So now we're at a point now where we're seeing similar types of levels. So we've got from the speculative crowd that buys calls to participate in the upside, because the person writing the call for yield, the guy on the opposite side is the guy that's buying that call to speculate on the upside. Okay. So you have to kind of understand the two sides of the game here. And so there's a lot more money going into calls than into puts. And you can see at the March lows how extreme that got on the other side. In late January, it got also very bearish as news out of China from COVID was populating around the world, except Donald Trump at that point, said it was the flu, don't worry about it. Forget the fact that he closed airports and those kind of things. So put and call option right now is extreme greed. So the speculator of the market, so Mr. Sports betting punter is using leverage to try to make a couple bucks. Okay, in terms of safe haven demand, the returns over the last 20 days and the difference of them between stocks and bonds. And normally this doesn't deviate too far, stays around 5 or 10% on either side of zero in general, but you can see the extreme swings that we saw in March and April, and right now incredibly skewed towards extreme greed. In other words, money has gone into stocks over bonds in the last month. That's obvious in when you think about that. So those do now market breadth. So McClellan oscillator, there's two of them. There's the volume summation index, and then you have the oscillator. One looks at volume and one looks at up versus down, advance versus decliner. So this is the volume summation index. And effectively it's at neutral levels, moving off fear. So neutral, okay, from a volume perspective, equivalent volume going into advancing stocks and declining stocks, that kind of perspective. Then you've got the volatility, and you've heard me say VIX, above 40. So currently VIX is down at 28. And it's not a trading indicator where above 40 you sell and below 40 you buy. There's no level, there's no number that does that. 28 is still very, very elevated. But what this indicator looks at is the level of VIX relative to its 50-day moving average. So roughly 4 months worth of trading, 3.5 months. I don't know why they picked the 50-day, but that's what they did. And they kind of look at the relationship of the VIX to its own 50-day average, and it's now come back below that. And they're calling volatility neutral. I would disagree with this. I would say volatility still very elevated, although it has come down considerably from its peaks. But as you'll see in some of my charts later on, that's completely normal behavior in the eye of the storm. Now we're looking at, again, another market breadth. How many stocks are making new highs versus making new lows? And we still have a fear reading in this indicator, according to what they're telling us here. So more stocks are still making new lows relative to new highs. And the last time was more extreme fear, a month ago compared to what it is sitting at today. Now we have credit risk, and credit spreads are amongst the best indicators. And the only reason, folks, that this has stabilized is the underlying support from the central bank. Otherwise, the amount of bankruptcy to come, the amount of downgrades of corporations with really crappy balance sheets getting downgraded to junk status, what they call fallen angels, is astronomical. And the Fed has implied that they're willing to buy that crappy paper. So it's that implicit support from the central bank. Folks, this isn't bullish. When the central bank has to print money to support the free economy, this is not a reason to be bullish. And that is a very different statement from the market being able to rally because of it. And if you can distinguish and understand what I mean by that. So the market can rally. I was fully expecting a bounce because we always get a bounce. And the only question is how high, and then what happens after. And I believe we're in the eye of the storm, but credit spreads are still wide. The market hasn't healed, and we have yet to see, and we'll see over the next year or two, just how bad corporate balance sheets are. Because once it's revealed that the emperor's clothes aren't as nice as people think, that's when all the crap comes to the surface and they can't bury it deep in the financial pages. That's where the WorldComs and the Enrons get unmasked. There's going to be lots of that out there. Wouldn't surprise me if the airline industry has some of that in it. We'll see in due course. And then mean reversion. How far are stocks above their averages? So they like to use a 6-month average, and generally speaking, in a bull trend, if you pull back to trend, you generally want to be a buyer. And it's not a signal that if it's below, you sell, if it's above, you buy. That's not how you think about this. You say markets only deviate from their mean a certain percentage before you get a snapback, but you can't time it. But it tells you a little bit about the environment. And of course, it was that extreme fear, according to deviation from trend and the historical metrics of this indicator. It's now in a fear stage, even though it's rallied back up to the average. They're still qualifying as fear. So overall, they're considering us kind of neutral area right now. And what does that mean? Okay. So when you put it all together, they're showing a neutral to somewhat positive reading for everything combined. And for me, we're in the eye of the storm because there's so much fundamentally that hasn't played out yet. So again, forest through the trees analysis. Rosie talks about this. I believe it wholeheartedly. The biggest economic hit in the history of the world to the global economy can't logically be a V recovery because so many behaviors are going to be changed. There's all kinds of surveys they're doing now and asking people, when the bars open up, are you going back? Those kind of questions. Are you going to take the subway? Are you going to take a commuter? What are you going to do? Are you going to go back to work? All those questions. And the vast, vast majority of people have cabin fever, without a doubt. Still, most of them are wearing masks. Most of them are still very, very conservative in their behavior. And that will melt over time as things loosen up. But I got to tell you, folks, I'm not getting on an airplane until there's a vaccine, or that I know there's nobody going to be sitting next to me coughing. I was on a plane, last plane I was on actually, in February. And, without sounding politically incorrect, there was an Asian woman sitting next to me coughing into a blanket, hysterically coughing, so you're not going to take that risk. And some people are willing to do it. Some people don't care. I'm not one of them. And I think the vast majority of people aren't one of them. And so the economy isn't going to be coming back. So the passivity of what we're seeing now must be the eye of the storm. And it's completely normal in the eye of the storm that volatility is declining. The headlines generally are okay. I'm looking at a story on CNBC that was sent to me came out a few hours ago. America's billionaires saw their fortunes soar by 434 billion during the US lockdown between mid-March and May, according to a new report. Jeff Bezos is now worth 34.6 billion more. Zuckerberg's worth 25 billion more. The American Tax Fairness and Institute for Policy Studies suggests that the Forbes 600 list, there's more billionaires today than there was 2 months ago. Point being that if we have a change in government, you are going to see a move significantly towards wealth redistribution, including wealth taxes, including higher taxes, including, you know, Department of Justice, splitting up the big, it's all coming. And that risk, you want to make that bet today, go for it. But you got to be a real Trump lover to make that bet today. You've got to understand this guy won by a nose hair in 3 swing states. You got to understand the Electoral College math. And I've made lots of bets. I've made the bets a year ago for different reasons that Trump wasn't going to win. But if the economy is still suffering and we get a second wave in the fall, which inevitably we're going to get, he's not getting reelected. And that's going to have ripple implications. So, last eye of the storm in a bona fide bear market. Just a little down and up correction that's 3 months that comes from some shock of some minor thing. That's not a bear market. A bear market is pain for a long period of time, a year, 2 years. That's a bear market, 3 years. So May of 2018, Time Magazine cover. No problem, things are good. Here's some tips. How's the next president going to make America grow again, surviving the economy? It's going to be a little bit lean, we're going to be just fine. Nobody really got, other than a few people who kind of understood what was under the hood. But look at VIX. Look at VIX in mid-May. It was down at 16. We're at 28. It peaked at 30, 35. It never got extreme until the Lehman moment. Now, the first wave was Bear Stearns hedge fund that was involved in these credit products around housing. And that was the June to July, boom, no problem, market's correct, snaps right back. Fed says we're there for you. In October, early October, Fed cuts 50 basis points, emergency meeting, market makes a new high for a couple of days. That was the peak. And then we had the 20% correction. And the bottom was marked by the day Bear Stearns went bankrupt and was bought over. It was Morgan Stanley, I think, that bought them. Maybe it was JP Morgan. It was one of them. And that was it. Systemic risk was over. You saw for a couple of months, those were the headlines. Housing, it's fixed. Bear Stearns is over. The cancer is gone. It's not even close. This is where we are today, I believe. Okay, but every day you get an optimistic headline, you get remdesivir, and you get Moderna, and you get all kinds of, you get the president who is dying to boost the stock market. I have no idea why he's beating up China right now, other than to take the eye off the economy and to put people's eye on presidential stump speeches. But the market hasn't cared one iota yet. But it will. Because the battle with China is very real. And the market that celebrated the phase 1 trade deal, like, that's done. It's over. They're not buying any soybeans if they can get them from Brazil. So we'll see how that all plays out. Now, China has their big 5-year bash, the plenum, starts tomorrow. And you're going to hear some political rhetoric around this. And listen, this is 100 years war. What's going on with China wanting to be #1 in the world and usurp the US? Listen, the US has got fat and lazy. It has. Just like the United Kingdom did, and just like every other dynasty did over the years, and eventually it's over. So this battle is going to be fought for decades and possibly the next century. And China is not going to quit wanting to be #1 until they're #1 or they're defeated. And historically, that defeat has come with war. Not forecasting that at all, but if you want an interesting read, Graham Allison wrote a book called The Cities Trap, and it's the story of change in leadership over the millennials. So very, very good read on understanding what that China war is all about. Let's look at the 2000 eye of the storm. June of 2000. So let's go and look at the chart. June of 2000. We had the first correction. The high of the market, as everybody knows, was in March of 2000. We had a little bit of a shock there, a little bit of surprise on earnings. By June 2000, the future of technology, smart cars, uppity robots, cyber sex, and everything about .com, front page, can do no wrong. And for months, everything was fine. In fact, we made another run at the high. We're holding above the 200-day average. And then we get another bit of bad news on earnings, and we have another correction, and then we get the rally, and the rally back to the 200 this time fails. And then we sell off again, and the rally back fails. Then we have a 20% decline, rallies right back to the 200-day. And then it rolls over again, and then we get 9/11. Then volatility spikes up, and it stays elevated for a couple of years. But the extreme spike, it doesn't stay there. It's a spike. It normalizes. It comes down. That's the behavior of volatility. Always, 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 always. So study history, learn from it, understand it. And I'm going to show you a few more examples. I'm not going to show you 87. That was a very different bear market. There was no recession in 87. I'm looking at all the ones that had recessions, and there's far more examples. I'm highlighting some of the major ones that people will understand and be somewhat familiar with. Those of you with grayer hair than me, I was 8 years old in 1973. I'll be 55 next month. 1973, the idea of Richard Nixon and Watergate, don't know what that is, didn't care. But when you go back and study history, you see there was a pretty significant hit to the markets in 73, and then we bounced right back, in this case, slightly above the 200-day, and it stayed there for a month. If anyone tells you they know how to navigate markets, forget about it. It's all about risk and return and evaluating your own circumstance. How much risk are you comfortable taking today? That is the only question that matters. And then you got to gear your portfolio towards achieving that goal. So in this case, we went above the 200-day, and then it failed a month later. And then didn't go back above until the impeachment and the oil embargo and everything else that 1974 was. And this was an era of high inflation and stagflation. Remember, 71 gold standard was broken, gold prices were rising, unions were strong. That's the world we're heading into, folks. If you don't think labor is going to speak up here, you're nuts. And they're going to be very strong and very powerful, and even more so under a more liberal agenda. So it matters who wins the election. Here in Canada, the Liberals, on the poll that I just saw today, are 20 points ahead of the Conservatives. And if you don't think Trudeau doesn't get that, and as soon as practically possible, he's going to call an election, we're going to have that. And then we'll probably see a Liberal majority. Not that I want that. I certainly don't. I'm president of the Conservative riding of Thornhill. I was an advisor to Andrew Scheer's party. He didn't listen to anything I said, but that's a whole other matter. So, eye of the storm. And everything was okay. Nixon's fighting back, right? Nixon's fighting back. Middle of the night. We're fine. Don't worry about it. Not the case, because the economic fallout was still had to play out. And it takes quarters and months and another quarter of earnings. We get into July, they start earnings again for the second quarter, and more companies say, nope, no visibility yet. And the analysts will take down their numbers because the companies don't know. And if the companies don't know, the analysts don't know. And then therefore you're guessing at what the valuation of the market should be. And when you're guessing, you're speculating. How about this? 1930s. Very famous economist named Irving Fisher came out only days, literally. So we had the correction in September. So go back and look at 1929. The first, it's not measured here on the graph, the first little shock down. And then the markets bounced. And Irving Fisher, Yale economist, elite Ivy League, Yale economist, says stock prices have reached what looks like to be a permanently high plateau. Front page, New York Times. Was he wrong? And that's a very, very famous nobody knows. Okay, very, very famous nobody knows. And you just, folks, you just have to understand that. Not me, not anybody else knows. And it has to be about a balance of probability assessment. It has to be. This next one, to me, has got to be the most egregious cover of all times. Time magazine's Man of the Year 1938. And what was to come for the world in the years ahead. So, eye of the storm. We broke support, we rallied back to it, and then the devastation came again. Because what happened here was not what's happening today, but Congress pulled back. Oh, we're fine, everything's good. We've recovered, the depression's over, we don't need all these special programs anymore, and they pulled back. So they're not going to make that mistake. There's going to be more largesse. There's going to be another bill, and there's going to be another one after that, and another one after that, and another one after that. And the Fed's balance sheet is going to get so damn big. And the question you have to ask yourself is, will it matter? Because eventually it won't. Now, here's Time Person's Magazine of the year, December 2016. Man's just elected president. This line is the day he was elected president and what the value line geometric average was at. The value line geometric average takes every stock in the US, gives it an equal weight, and it says what is the percentage change every day of those average stocks. Okay, so what has the average stock done since Donald Trump is elected? And it's down. The markets are up. Very, very few stocks are participating. The average stock isn't doing very well. In fact, the average stock peaked in 2018. The economy is not great. It never was great. It was fragile. We've only been able to hold it together with glue. My topic for tomorrow's BermansCall show is discussing Ronald Reagan and the Reagan Revolution and cutting taxes. And Trump fancied himself Reagan. He's talked about it, and he wants to do what Reagan did, and times are great again. Reagan had tailwinds. 1980, baby boomer was hitting the stride. The internet, technology, Microsoft, Apple, that was the early days. There was a tailwind of inflation being broken from Paul Volcker raising rates. You had a tailwind of 40 years now falling interest rates. And they're going to continue to fall. So, you know, that's and so what this is not real. The average company is sucking wind. A third of the Russell 2000 makes no money. And that's when things were good, prior to COVID. The world's fragile, folks. And there's going to be tremendous bankruptcies. I just don't know how it's going to play out. But make no mistake, it's not a V. So just a reminder of my shopping list before I get into questions again. And I want to get to as many of your questions as possible. You've heard me speak for weeks and weeks and weeks here, and I've really enjoyed doing this thing. We have one more week left in the roadshow. As things open up through the summer, I'm sure you're not going to want to spend your Thursday nights every week here with us. You'd probably want to be out, you know, in a park or doing something a little more leisurely. We're going to continue to do the webinars in the summer months, probably on a monthly basis, not a weekly basis. I do want to keep in touch and have the ability for you to ask questions and get some feedback on your portfolios. And then we'll see what the fall looks like. But I imagine we're going to go back to a webinar version. We're not going to be on airplanes doing these things in Cineplex theaters across the country in the fall. I'm pretty sure of that. So I've talked a lot about what I like, the areas, robotics, artificial intelligence. There's tremendous ways to play these things. You know, ZPay, one of my favorite ETFs, big part of all my portfolios. The young world, developing markets, great ways to play, you know, duration in gold, etc. Kevin talked about. Now, the coming inflation period, you know, we want indexed inflation bonds, not yet, too early, not yet. But at some point, an inflation theme, the infrastructure play, which inevitably we're going to get a bill. I don't believe we're going to get an infrastructure bill till after the election. But mining stocks, copper, base metals, steel, going to all do very, very well. There's some ETFs for that and so forth. So let's get into Q&A here. Oh, before we start the Q&A, let me then do another poll here. Again, same question as before. I'm going to launch it up there for you. We're going to leave it open for a minute. We've got another 100 people that have come in since we did the last one. So let's get everyone voting on this. Is the S&P 500 likely to be 10% higher or 10% lower? About 50% have voted for so far, 85% lower, 16% higher. So maybe a few people on the margin have moved off their views, 10% higher before lower. Doesn't seem to be too different here. Okay, well there's a minute there. We'll close it off. Pretty close to what it was before. We had 72% of the audience after a minute before, 77% voted, so roughly 800 people voting there, 82% say lower before higher. It was 80-20 before. So, you know, maybe a few people heard what I had to say. Maybe they moved their opinion a little bit, not sure. But that's what happens with sentiment. So there's an overwhelming amount of cash on the sidelines. Dips are going to be well bought. It's very possible we don't make new lows here because people are waiting for that opportunity to buy. So that's very interesting, something to think about and consider as well. Let me now go back to the Q&A here. before I turn the Bloomberg screen on and see how everything's looking there. Okay, so what would your trading strategy be if a vaccine is found today? Well, first of all, vaccine won't be found today. At a minimum, we won't know for 6 months if the vaccine or anything they're working on today has any reasonable efficacy on a broad basis. There's just a process. What they are doing today is saying, we think that's going to be good. The preliminary phase 1 stuff is good. We're willing to spend $1 billion today and produce all this vaccine, so we'll have it as soon as possible, with the assumption that it's going to be good and we can give it to the frontline workers and everybody else and try to avoid a second wave in the fall. That's what a lot of money, and you know what? That's a good spend. But we're not going to know factually. Today, it's all conjecture and speculation. And every epidemiologist has a slightly different tilt on that, depending on their political bias, I believe, in a lot of cases. If they're more liberal leaning, they're telling you 12 months, 18 months. If they're more conservative leaning, supportive of Trump, they're telling you it's likely now if they have any other kind of agenda. It's hard to know who to believe. I've asked as many educated people as possible these questions, and I get as many different answers so nobody knows, folks. So is the market still overpriced? Absolutely. Because it's the economic fallout. Even if there's a vaccine, it's not going to be a V. You're going to have millions and millions of people who are going to permanently change their behavior, who are not getting their jobs back. It can't be a V. Okay? So that, I hope, Lily, gives you my answer on that. Over the last 20 years of globalization, we've seen great currents of money flowing from the United States to China for goods. In turn, China has flowed money back in raw material supplies. Energy states have flowed much of that money back into American, European stock and bond markets. What's your view of the possible impact to the financial markets of the reductions in this money flow brought by COVID-19 demand drop and the recent American policy announcements? Ron, that is part of the core essence of this new Cold War, perhaps hot war one day, hopefully not, with China and the US. And nobody knows. I listen a lot to geopolitical thinkers. I tune into as many geopolitical conference calls and webinars as I possibly can get access to. And again, lots of different opinions, but the consensus is this is a battle that's going to last years and years and years and years and years and years. And it's not priced in, okay? Mike's asks, the markets keep going higher. Is there no connection to economic realities? Well, that's basically, what I'm saying here. Now, do we go back to the lows? Do we undercut that lows? Is it a moot point? Again, goes to the question of risk and return. Mike, do you want to put your money in now, knowing the probability of it going higher versus lower? That's it. Do you want to bet money now on 10% up versus 10% down? And if your bias is Fed largesse is bullish, then you bet on up. No problem with it. Go for it. But understand you're buying a very expensive market. And if it doesn't turn out to perfection, your risk-reward equation is not attractive at the moment. My question is, given the current high volatility, how does one implement a dollar cost averaging strategy for long positions? The temptation is there to try to time the market. Okay. Do not time the market, okay? But here are some facts you should know. The biggest days are the ones directly after or very soon after the worst days. So on days that the market's down 2% or more, buy the close. Okay? So if you have a pool of money that you want to put to work, don't buy it on the days the market's strong, buy it on the days the markets are weak. You will have significantly better long-term performance than buying it when the markets are strong. If you're talking about adding new money on a dollar cost averaging basis. That is fact. You can prove that. That's the way to do it. Okay? You're not timing the market. You're strategically deploying as opposed to saying, I'm going to buy on the 15th of every month because that's the day after my paycheck hits my account. That is stupid. Pardon me, bad word, folks. That is not as good as it could be in terms of deploying your money, because that could be a huge up day. And if you put your money to work after every huge up day, you're going to have a terrible average returns in the long run. Wonder what my thoughts are holding stock in senior living facilities. So I'm not sure, Brian, if this is the same question. I answered one online before here, but I gotta say, 50%, 60% of the fatalities related to COVID have been linked directly or indirectly to seniors facilities. And I'm just using a tire kicking example here. My father-in-law said, no way, like pointing his finger in my face, no way am I going to one of those. Now it was over the phone and you could hear him, you could see him do that. You're never putting me in one of those, but his parents were in one and my mother-in-law's parents were in there in their last years because that's what we do. I believe aging at home is where you can afford it and it's possible is going to be a huge growth area. Huge. So companies that install elevators and retrofit homes, huge. I don't know who they are. Huge. And for the people who don't have the means are going to go into extended cares and shared. My mother didn't have the means, and back then I didn't have a lot of money to make a difference for her, was in a room on a quad. She shared a room with three other people in a retirement facility because I was born into poverty, ladies and gentlemen. We had nothing. When my parents retired, they had CPP, OAS, and a guaranteed income supplement. And my dad, for breaking his back and working in a warehouse for 30 years, had a pension that bought a little bit more than a meal out every month. And that's, what 50% of people are faced with in their retirements. So there's going to be need. Okay. But what I'm saying is the marginal person isn't going to go there. So I don't know what that means, but right now there's more pain to come, I believe, here, and I wouldn't be stepping in, Brian, if that answers the question at all, or my 2 cents on it. Market snap back with some strength, indicating confidence in what central banks are doing. So yes, for sure, flooding the market with all this liquidity. Don't fight the Fed and all. I've talked about that for a number of weeks. I talked about it with Rosie. Seems to be the right attitude to take. So you can take that attitude, but understand, because they have to do that, this is not bullish, okay? This is liquidity, it's supportive. That's a different thing than being bullish. I hope I'm being clear here in trying to articulate my viewpoint. You can call it a glass half full view if you like, because it is. I don't like the fact that we've got to run massive deficits and have interest rates at zero and have the central bank printing money just so the economy can grow a little bit. I don't like it. I think it's awful. I think we've got a failed business model, frankly. So I can't be bullish about that. Okay, Raphael, I hope that gives you my view. But it doesn't mean the markets can't keep going higher. because there's example over example over example historically that we get into these confidence periods, and we're in one now. It's called the eye of the storm. It's called the hope rally. So we'll see how it all plays out, but it's not a bet that I'm going to make. No doubt, Raphael, you are in the 20% who thinks 10% higher before lower. My question is, would you consider Horizon's Beta Pro Enhanced Gold Producers Income Fund, HEP, as a good way to have a position in gold? So if I'm not mistaken, it's a covered call strategy. The income comes from the optionality around gold and gold producers, and it's not the best way to play it here. No, when you're bullish on something, you don't want the covered call that gives away upside. You want the maximum potential. So it's not bad. You're going to get upside. You're going to get some yield out of it. But no, I wouldn't be playing that. These covered call strategies tend to be for a defensive view of the sector. You want to be there, but you're not sure. You want to be there, but you want the yield out of it, and that's more important than the growth. But if you're in the gold sector because of the narrative around why we should own gold today and central banks printing money and the negative real yields that will eventually lead to an era of stagflation, that's why you want to be in gold and not covered. Sandra asks, would I buy the NASDAQ here? Well, no, the NASDAQ's the most overbought part of the market. But if you saw my buy list, the NASDAQ's on it, and technology in general, I'm wildly bullish on. I'd have no problem buying the Qs today if you were to neutralize the market risk with some kind of option strategy, because it's likely going to continue to outperform. But at the bottom of every bear market, everything gets sold, even what's working. Microsoft's, they're all getting hammered when the final bottom is in. When that comes, I don't know, but we're not there yet. If my thesis is correct and we're in the eye of the storm. It may not be, because I'm only right 2/3 of the time. Retired and need a stable income. How will ZPR hold up during the downturn? Will yields fall as well as the ETF value requires stable income, not growth? So there's a real fundamental problem with the reset preferred market in the era we're in now. And I've held this as a way to get yield, and frankly, it was a benefit of hindsight. The money could have been deployed better. So I don't like it. I'm not adding to it. I have no plans to add to it. If anything, we're going to be lightening up into strength. But it is a differentiator in terms of a different type of yield that you can earn and a very different path of returns. Ishwar is asking, is it reasonable to think the Indian currency will weaken for the next 12 to 24 months or any period after? Let me see if I can bring up a chart here. See if anybody's got here, INR. So here's the Indian rupee spot currency. And what I'm going to bring up here is a long-term chart. And I'm going to max that chart out. And it's going to show me going back to the early 1970s. And you can see that the trend is bearish. And so the question is, will the Indian rupee weaken in the long term? One of the reasons why is higher inflation and higher yield. And typically, you are going to see an erosion in a weaker currency that has twin deficits, which India does. They have a trade deficit and they have a capital account deficit. So more money leaves the country than comes in on both fronts. So from an investment standpoint, now it's interesting that if Trump somehow is able to get some production that's done in China moved to India, then maybe the capital account improves and we get some stability for a while. But the inflation levels in India are going to remain higher. You're going to see about a 4 to 6% to 7% differential in terms of US dollar or Canadian dollar to Indian rupee. And therefore, you're going to have a natural tendency for that currency to depreciate at roughly that level every year. And you will get pockets and periods where things are better, like we saw from, say, 2000 to 2010, where it stabilized roughly in a trading range for many, many years. And then you get the bad periods again and it starts trending. So I don't know what it's going to do over the next 12 to 24 months, but I would be biased towards more weakening there, periodic rallies, but be prepared for a weaker currency. Let me go back here to questions for Justin. I'm a young investor. I've never been through a financial crisis before. Well, you're not alone, Justin. I would hazard a guess that 30 to 50% of investors today have never seen a real bear market. And they don't know what to do, and they don't know what to expect, and they weren't putting a lot of money at risk if they were interested in markets back then, so you don't have seasoned veterans that have been through 2 or 3 or 4 of these, many of them, but you have some. So how's it the market can look past everything? Because the markets are largely irrational. Justin, the markets are largely driven by narratives and emotions. Today, arguably, the people buying the market today are buying into the Fed story and liquidity and don't fight the Fed and are naive. And they're not. If you look at the seasoned investors, Warren Buffett, who has seen many of these cycles, there's a reason he has $130 billion in cash. And there's a reason during that last shock, he was actually a net seller, not a net buyer. He's scared shitless. He knows what's coming. Valuations today are absolutely insane, but they could stay that way for who knows how long. And that's what you have to struggle with now. So what if you're a momentum investor, then you have no problem buying the market here and selling it higher. But if you've got a value tilt like I do, you can't buy the market here. You got to be more cautious. It's just way too risky. There's no intrinsic value. The Graham and Dodd, buying companies that are cheap, buying securities that are underappreciated and underowned. There's not a lot of that today, but those are the companies that you're going to want to own. Not the department stores, not the buggy whips of the future, not the beaten down stocks that may never be the same. Okay, but the ones that are great companies that have great potential that have been sold for bad reasons. Those are the ones that are going to be there. And again, I'll talk a bit more about that on tomorrow's show. So I hope that gives you some insight there. Can I explain how the recently passed Senate legislation will affect Chinese listed stocks? Downtown Josh Brown stated it wouldn't really affect Chinese stocks with American accounting firms. I own ZCH. ZCH is the Chinese MSCI index for the BMO has. So, I think Chinese stocks have some intrinsic value. They're not overvalued. They're relatively cheap compared to many other places in the world. From that perspective, I like Chinese companies. I like Chinese A shares a bit better. They're cheaper than the Hong Kong listed ones. But make no mistake, a lot of the risks that are in the marketplace today are very, very real and are not priced into the tape. And so I think Josh Brown likes to tell a story and likes to be a bit more positive. So I would discount, me personally, some of the things that he would say. And I'd put him more in the pom-pom category along with Mr. Kramer, I think. The fast money guys, the fast money crowd on CNBC tend to be far more pomp and circumstances and momentum and narrative than they are good securities analysis, but that's just my take, not meaning to offend anyone. I'm sure if they were watching my show, they would just call me a perma bear and you know, don't listen to him. He's wrong. I've won awards for my sleep at night approach to markets. So I don't know. It's going to be an issue. It's not priced into markets. I wouldn't be chasing. But the Chinese move from being a net exporter to being a consumer-driven economy is going to be very bullish for the Chinese consumer. And that I like. So Alibaba, JD, those are some good companies. They're very overvalued, like many of the US online tech plays are at the moment. And they're probably going to stay that way. So you've got to be a dip buyer. I wouldn't buy them today. Another China question here. So I've knocked that one around today. How long does it take? Measured in years and years and years and years. Will outlive Donald Trump, who's only got a few months left in his presidency, in my mind. But I would argue that the Democrats may be more hawkish on China than Trump is. They'll just do it differently. 6 months from tax loss selling. Yeah, it's far too easy, too early to think about buying stuff for tax loss selling at the moment. Far too early. If VIX stayed below 40 for more than a week, it could conclude the bottom is in. I've addressed that before. The answer is no. I use that as a benchmark because that was the level in 2008 that held. Clearly, it didn't help, but volatility is still relatively elevated, and it's not a reason to think the lows are in and you want to buy today. Okay, so that's it for those questions. I've brought my Bloomberg screen up again here. I'm going to bring up the questions that have come in online here, and hopefully everybody can see these, and then we'll go through them, and I'll try to get through as many as possible here. So am I allowed to short in ZZZD, sleep at night dividends? I'm not allowed to short, but I am allowed to hedge using options. And the portfolio at the moment is fully hedged. My beta risk is fully hedged. So I'm going to expect extremely low volatility. I'm exposed on the long side to a bet against the US dollar at the moment and a big bet on gold. And I think that's going to be good. And my yield is going to be somewhere between, realized yield, somewhere between 4 and 5% over the next year. That's how I'm positioned. But no, I can't short things. And you're welcome for that free trial. I hope you're enjoying Rosie's research. Do I think real estate may become a good investment? So real estate's tough, guys. I'm not a real estate expert at all. I think depends what kind of real estate you're talking about. I think that's a big issue. I don't think that there's good value there yet. I think there's a lot of people are not going to be able to maintain their jobs. I think commercial real estate's going to take a hit as companies reevaluate how much office space they need. I think retail, in particular shopping malls, are going to take a massive hit. So REITs overall are going to be stressed for a while here, and it's far too early to get bullish on them. Given the amount of liquidity pumped in, are we going to test the March 2020 lows again? I think yes. I think it's a virtual no-brainer. I think we actually undercut those. I don't know how it all plays out, but it seems clear, given the central bank large S, that we need a second wave, probably, or a real acceleration, a fist fight with China. And so this all plays out as we get closer to the US election. Seasonality-wise, on the second wave of the flu, on the reopenings, and then on the election risk of seeing a change in government. So that'll play out in the third quarter. We're probably okay stability-wise for a few more months on the markets. I have two gold positions, Kirkland Lake and the broad XGD, 50-50. XGD is performing better. Should I switch? Raffle. So listen, I'm not a stock picker. I can do it. What I would do is not try to pick the winner. You get caught up in the story. You don't understand company-specific risks. And companies that don't execute will underperform. So for me, it's about being in the right space and getting the theme right than trying to pick the winning horse. And so I would rather be, for me, not for you, for me, I would rather be in the ETF. I'm not telling you what to do. I'm telling you what I would do, but think about it from that perspective, Raphael, and see if that gives you some clarity there. Sean asked, do I recommend retail stocks since we're opening up? Absolutely not. We might get a trading rally. So if you're a trader and you got your trading fast money hat on, maybe you could buy some retail stocks for a pop, but I would think not. I talked about preferred resets, Rob. I'm not going to go into that one. For gold bullion, do I recommend hedged or unhedged, giving the Canadian dollar value? I think for now, the Canadian dollar risk is to the downside. I'm much more wanting to buy US dollar exposure at the moment, being hedged. I was fully hedged in my exposure at around 68 cents, approximately 146 traded terms. I think we'll see that again. And so at 139, I want US exposure here. What if Argentina is forced to sell their gold holdings for cash? How much will gold and gold ETFs drop? John, I have no idea. Russia stopped buying. That had an impact for a few days. So obviously, when that news circulates and people speculate, I think a lot of people push a narrative. They push a narrative to generate a market response. People stop out. It creates liquidity. And if you don't believe there's a lot of people trying to game the market that are professionals, putting out stories like that to shake out weak holders and get better buying opportunities, you don't understand markets. So who knows? And what if India all of a sudden starts to buy? And what if, so I don't think all those things, or any of those things are really meaningful. Get the theme right, understand the big picture, don't worry about the noise. What if Kathy asked, I would like to get into cyberspace. Sierra Wireless, Cisco, Salesforce, NVIDIA, any thoughts? So I've given my thoughts, Kathy, on the whole cyber area. I'm not a stock picker. I have no idea which one of those companies would be the winner. I would much rather own an ETF like cyber. So CIBR. So this ETF, first truck, it's NASDAQ cybersecurity ETF. If we kind of look very quickly at what's in it, what makes it up, and then we can look at the picture. So this is $1.6 billion in this ETF. It's a big one. It's a player. There's the expense ratio. If you want to look at some of the holdings, we can have a quick look at the top 10 there. There are some of the names. If you look at the subsectors, computers, internet, software, there's a lot of different ways to play cybersecurity. Big weighting in the US, some exposure to Israel, UK. So you got different currency exposures in there. Current dividend yields, 1.5%. There's some of the fundamental ratios. Let's have a look at the picture here. So I like to look at, is it overbought? Is it oversold? What does it have? I would love this thing. I didn't buy any. at the low. Would love this thing. Risk reward. It was at the same low. Where did it come from? Let's do let's go back 5 years here. Let's see how much history is there. Okay, so at the bottom in early 2016, which was the base of the last bull run, this thing was at 13. Probably shouldn't see those levels. If we get anywhere close to the low 20s, I would say at this point it's got to be a very, very strong buy at that point. Would I buy it here? Yeah, you could own a little bit here. I don't. I would play it this way as opposed to trying to pick which company is going to win the race. If you remember in the dot-com boom, there were so many of them. 99% of them don't exist, out of business, were bought over. 90% of them went bankrupt, not saying that's going to happen to the cybersecurity space, but I would much prefer to play it on a diversified basis than trying to pick the winner. Don asked about HEP. I think I answered that one. MNT, would I recommend it? So I believe MNT is the way to play gold reserves, the Royal Canadian Mint. Sure, no problem. I believe it holds silver as well. There's a portion of silver bullion in that as well. So book-based gold ETR. I think it has some silver too, but I'd have to double check that. If we see, it shows what's in it. No, it doesn't show the holdings. Canadian ETFs aren't good at showing what's in them. You'd have to go to the website. I have no issue with that ETF if you want to play bullion that way. Would I recommend short-term bonds, XSB, or a broader Canadian bond market with negative rates compared to XLB? If you're making a bet on interest rates and you're bullish, you got to bet on long bonds. The Fed narrative over the last little while, we saw it in the minutes that came out yesterday. Yield curve control is coming. They are going to anchor yields at a level so that over the next number of years, they can issue as much debt as they possibly can and yields won't rise. And that's coming. And so you can be relatively confident that yields aren't going to back up too much at the moment. At some point, we're going to have a problem because it won't be unlimited balance sheets, and the US dollar will take a big hit. But that could be years and years and years into the future before that's a big issue. Okay, what else do we got here? Silver relative to gold. So let's see if I can do a gold-silver ratio here. So I'm going to use SLV, which is the Silver Trust ETF. And what I'm going to do here is I'm going to bring up a ratio chart, and I'm going to compare that to GLD, which is the gold ETF. And I'm going to look at that ratio, which is the bottom chart here. I'm going to normalize it, which puts it in percentage terms, and I'm going to look at as much history as I can get here. So there's 5 years. Let's see if we can go back longer than that. Beautiful. So the gold-silver ratio at the last peak was way up here. And we're way down here now. So gold has outperformed silver. And now with this line rising, silver start to outperform gold. And in the last phase of the cycle, can't go back much more here, but in the oh, look, we got more history. Terrific. So in the last phase of the cycle, when things are good, silver outperforms gold, and that ratio goes up. So silver looks relatively more attractive. Let's have a look at the beta, or the risk of silver relative to gold. So silver relative to GLD. So what this function on Bloomberg does is it says, what's my beta? What's my sensitivity movement between silver and gold? So obviously R squares high, there's a pretty high correlation. but the beta is 1.3, a raw beta. And what that means is on a daily basis, over the last 2 years, I could change this and look at a 5-year. So let me go back to 2015, see what it shows me here on a daily basis. So about 1.125. So you're going to get about 1.25 leverage being in silver relative to gold. And if you're bullish and you're comfortable with more volatility, because a higher beta, higher than 1, means more volatility, if you're okay with that, then silver is the play. So folks, that's kind of how I go about, analyzing things. I look at charts, I look at behavior, I look at history, and then I make an assessment based on everything I know about that company or that sector, and I look at it relative to other things that I could possibly own. Okay, and that's kind of how so you can see some headlines. China omits 2020 GDP target citing virus and global uncertainties. So that's interesting. So China's now starting their plenum, and they've come out and said, we don't know what growth is going to look like going forward. But historically, they've always had a managed target. And that tells you how difficult it's going to be for China and for the rest of the world, frankly, on on what's and how things are going to play out there. What else do we have here? Question wide. I said higher, but that's just because what I was thinking crazy markets will do, not because I'm bullish. Okay, John. I think it will go lower, but fear that I'm wrong, fear of missing out. Andre, very good. What are my thoughts on emerging markets? So one of my favorite things that I hear is coming out of this is emerging markets, but we have to be very specific on which ones. Brazil, and the current leader in Brazil is enacting tremendous reforms. And in that part of what Bolsonaro is doing, it's Trumpian-like and very positive, for the economic reforms. But Brazil is a basket case, and they totally botched COVID. And there's going to be a wicked second wave. And for now, Brazil isn't attractive, and it's so leveraged to oil, and oil's not going to be what it was. So I don't like Brazil. I don't like Russia for the same reason. And so buying just a broad emerging markets is not the best way to play it. I think you got to be targeted. I think you've got to look at a Malaysia. I think you got to look at a Vietnam. I think you got to look at a Thailand. I think you'll look at frontier markets, parts of sub-Saharan Africa, and so forth. So I like emerging markets coming out of this. Some of the biggest risks are currencies, but the US dollar is very, very strong right now against everything. So there's some attractiveness in owning some of these foreign market currencies. I love India. Currency's a risk there, and so forth. Next 10% should be down, but there's some irrational investing taking place and so forth. Okay, so let me go wrap here. I'll minimize my screens here, and just finally, thanks to everybody that participated in the webinar tonight. You will get a questionnaire that'll come out tomorrow. It'll have the replay on it. Please, as Jared mentioned, there's different ways to engage with us. If you're interested in getting a review on your portfolio and you qualify, please reach out to us. There'll be a box you can tick in the survey. Go to our website, etfcapitalmanagement.com. Go have a look at the BMO funds we manage on the website, ZZD Portfolios. Go have a look at our weekly updates there. The most important thing you could do is get an independent assessment and a long-term financial plan done. And U Potential is all about helping you reach your full potential. And there's no obligation at all to invest with us. You can be a do-it-yourself investor, but understand that you have an expert person helping you, a team of people in terms of estate planning, wealth planning, how much risk you need to take, things like that. Golden Girl Finance and Q Wealth as a website for financial advisors that would be interesting in becoming a partner with what we're doing in terms of investor education and really speaking to Canadians about having to make better decisions. So folks, thank you very much. Please, if you can, $20, $50, $100. A couple of people have reached deep to, there's been some 200s, a couple $500 donations. Leukemia research at Sick Kids Hospital. Jared and I will match your donations. Baycrest, dementia and Alzheimer's. If you can't make that decision, you are not you. And please help eradicate some of these diseases that are so cruel to so many people. Thanks very much, folks. One more week to go on this, and then we'll do it monthly for the summer. Thanks so much. See you on BNN tomorrow at 4:30. Have a great week, everybody. Stay safe and healthy.